and thank you for the opportunity of presenting today. The topic I'm introducing, the ethical supply chain finance, is something that sits between reality and what I expect as an industry analyst to happen in the very near future. What do we mean by ethical supply chain finance? Well, a brief definition. The ethical supply chain finance is about being committed, first of all. The different flavors of being ethical. And I have to say that even though the name explains that there's a sort of moral component in it, it's not about being necessarily nice. So there is a business need or business sense to be ethical. Being committed to pay invoices to your suppliers according to contractually agreed upon terms is important. It's important because you want to make sure that your suppliers do not go disrupted because, again, you want to be smart. You want to be nice, you want to pay your suppliers on time, but there is also a business sense for doing this. Is because we know that supply chains, really I would call them supply networks, are an intricacy of companies that buy and sell one to another. So in reality, you don't have a one single anchor company that controls its entire supply chain. You have a myriad of companies that buy and sell from each other. And so the risk for a company is that one link of its supply network is weak and goes bust. So from a financial perspective, you might have a company that is financially distressed, is good in terms of operations, is good in terms of products they sell, of quality they sell, but they have financial problems, financial distress. And so if as a company, in this case, let's say the anchor company, so-called in a supply network, so the company that somehow has a strong control, has a strong negotiation power, if you don't consider the opportunity of ensuring that your entire network of supply participants are financially stable, the risk is that some of them will fail, not because of bad product quality, not because of bad production, but just because they are short with money. And the smaller the company is, the higher the risk that they cannot access liquidity in a cheap way, or in some situations, even there's no bank that will ever give them the opportunity to get that money. So you want to pay on time your suppliers because you want to be committed. You want to be, let's say, ethical, meaning being nice, but more and more is because you want to be smart. And the third component of the ethical supply chain is that you must be proactive. What does this mean? This means that, of course, if you know that your suppliers have some financial problems, you might want to offer them an early payment discount, or you want to facilitate the access to finance. But this is being reactive. Being an ethical supply chain finance company means that you proactively understand the weak links in your network and then ensure that those companies will have access to finance whenever needed. It could be an early payment, it could be more sophisticated supply chain finance solutions like reverse factoring, dynamic discounting, factoring, receivables finance, no matter what the instrument is and no matter where the cash comes from, either from the company itself or from third-party providers. But being ethical in your supply chain finance policy means being able to anticipate the risk of financial distress of any participant in your network, and therefore doing that ahead of time when you don't have problems. And as an industry market research company, what we expect is that the principles of the ethical supply chain finance will be the ones who really will put some substance and will help companies justify the compliance with the EU Late Payments Directive. So I think you are familiar with it, but basically what the Late Payments EU Directive recommends is that companies will have to pay their suppliers in a limited number of days, 30, say, a maximum 60, in some situations 120, but not beyond. And being a directive, this means there's no choice, you must do it. Now the problem is that this situation, I mean, this policy of this directive actually will put some relief on small companies because they can claim to get paid on time by their large supplier, the large buyers. But the odds are that you can win at court that you are not getting paid on time. But guess what? You will lose most likely your contract because your large clients will say, okay, I've been paying you late. Now you're applying this directive. I'm forced by court to pay you on time. I also have to pay some extra cost for, let's say, the cost of claiming and doing the whole, let's say, court procedure. But I don't want to have anything to do with you any longer. So there is also, even though in principle the directive is in favor of small and medium enterprises, in reality it's not helping them that much. Now the point is that if instead, as a large company, I do understand there is the need to support proactively the companies that are financially distressed in my network, it's still difficult to justify that. So why should I pay early or why should I pay on time these companies? Isn't there any way that I can extend payments because that's good for my working capital ratios? Now, the EU Late Payments Directive somehow gives a justification, so I must do it to be compliant with EU legislation. And moreover, supply chain finance helps to solve this conundrum. On one side, according to the directive, I need to pay my suppliers not necessarily ahead of time, but on time. And so as a company, as a buyer, I cannot extend my payment terms. So how can I comply with the legislation but still ensure that my working capital, let's say, strategies are implemented? The EU directive gives this opportunity. So if I want to be a supply chain finance ethical company, I can use it to build the internal business case to say I have to be compliant, but at the same time I can use supply chain finance instruments that allow me, through a third-party funding provider, to pay my suppliers on time, and at the same time I can still extend my DPO, my days payable outstanding. And so if it's difficult to build an internal business case, I would recommend companies to look at the principles of the EU directive, to comply with these principles, but at the same time also to build a necessary business case, to implement the necessary actions. So being committed to pay, being smart, nice, but also especially smart, and being proactive, let's say, are the three principles of an ethical supply chain finance company. And I would say, moreover, I think we're all familiar with the concept of a CSR, corporate social responsibility. These are still, there is a sort of proactiveness, but they are very much looking at the social responsibility, not using child labor, for instance, being environmentally friendly. But very little so far has been done in terms of how responsible am I as a company in a sort of financial relationship with my supply base, and for that matter also with my distributor base, because let's not forget that in a supply network you have suppliers but you also have distributors. And if you are in some specific industries like the electronic industry or the automotive industry, your distribution chain is much more important than your supply chain, your supplier's chain. And so the whole concept of being able to anticipate the need of your supply network partners is absolutely imperative. And I expect that if it's not called ethical supply chain finance, whatever you want to call it, but these three principles will add an additional driver to select those companies that are CSR, so corporate social responsibility, from those who are not. So I would say that the finance piece goes under this header. Again, the name can change. Some argue that ethical supply chain finance is too sort of poetic or something too moralistic. Never mind. What's important is the three levels. And the importance of this is not just because somebody thought about it, but as analysts we need to validate our assumptions with facts. And so I recently did a research, and this is just one screenshot from a report that has been recently published about what does it mean being ethical from a supply chain finance perspective. So the question to a number of European small and medium enterprises was, in case of I will explain what is written there. Basically the question was, if you have a way to rank your customers in terms of being supply chain finance ethical or not, and you know that our supply chain, that a company, one of your buyers, is not, let's say, ethical according to these standards, would you use this ranking, so bad ranking of this company, to put more pressure on them? Would you team up with other companies in order you put pressure? Just like today, if you know that a company is using child labor, that is disrupting its brand, but also if you are one of the partner companies, you can put some pressure in having better negotiation terms. So if you have something similar from an ethical supply chain finance perspective, would you use this as a negotiation power? And you see that, or would you take the lead to basically build a group of pressure, to put pressure on this company that's misbehaving in terms of not being supply chain finance ethical? And the answer here is that, you see, there are let's say the number, the panel was of 24 respondents, so we cannot say that it has a statistical relevance, but the people that were interviewed were people that somehow have a good opinion, so they are qualified. And for us analysts, really it's not so much the quantity that counts, but rather the quality. So this can help drive, given the kind of information that you see that only 6 out of 24, let's say 7, considering that this is not available, did not want to answer. 7 out of 24, they have no opinion, or they have a strong opinion that they would not use the ethical supply chain finance benchmark to sort of use this as a negotiation power. But all the rest, they strongly agree that that would be a strong tool or a strong weapon they could use in negotiating with these sort of bad, non-ethical clients. And what is very important, I would say that 3 out of 24, they also would take the lead. Because the problem here is that everybody says, yes, if we can team up, of course, as a small company or as a one company, you cannot play against your big buyer, who is, even if it's misbehaving, is still a big buyer, and again, you can lose the contract. But in this case, they would team up and they would take the lead, i.e. creating this group of power, a group of pressure, and using a matrix or a ranking system to calculate a KPI, a key performance indicator, for being supply chain finance ethical. And there are already some key performance indicators, some initiatives that, even though they are not addressing specifically the term ethical supply chain finance, they are leading to that way. You have the initiatives, for instance, in the US, you have the supplier pledge. So there is an initiative where large companies have signed an agreement, basically a document, where they say that they will treat their suppliers according to the principles of fairness, and will help them also proactively in providing them with financial supply chain finance instruments. You have the UK prompt payment code, which is still addressing prompt payments, but is using a ranking system. So while companies before were trying to not being pushed to being ranked as prompt payment payers or not, now they want to join this ranking system to prove that they are actually paying on time, and so they are somehow addressing one of the 3 categories of the ethical supply chain finance. In Italy, also my country, there is also a similar initiative. So we don't have yet groups of small and medium enterprises that are teaming up together to put that pressure. As analysts, we always have to look at what potentially is going to happen in the future, but the trends are that just paying on time suppliers is not enough. It's certainly a first step, but with that you need, first of all, to be proactive, as I said before, so making sure that that happens without the necessity of doing it, and moreover is to be smart, so also to offer those supply chain finance instruments that might not be necessary today, but certainly can prevent a disruption in the supply network, which will generate a negative impact on the company itself. And the risk for a company that thinks that all this is, just a nice academic exercise, but nothing more than that, is that there are at least 24 companies in Europe. Let's say, what is it? 21, 24 minus 7 is 17. 17 of which they would be ready to use a ranking system and to start considering ethical supply chain finance as an additional component for corporate social responsibility analysis and performance. So with that, I wish to thank you.